I would like to say that 这是非常重要的演讲. I think I did it okay. And one more important thing. 所以请不要睡觉. That's very interesting. In both sentences, there is 要, and I have no idea what it is, but it's a very, very difficult language. I will learn it. Don't worry. About this measurements. Today we are going to talk about generally profitability measurements or rentability measurements. This is all about how good the company is in producing profit based on certain other numbers, I would say. So people might argue that ratios are important, are not important, or you could run business by your nose, or you could run business by speculation or something like this. Obviously, everybody has a right to see things and judge things in own way. And of course, there are successful companies that are run like this, but I think that at certain level of corporation, at certain level of quite a large, complex company, calculating ratios is very, very important. As well, it is important for investors, particularly these investors that do not know company like personally. They just have some documents. So in order to assess the soundness of the company, they would need some numbers, some measurements. And of course, you could read 100 pages or 500 pages of annual report. Or as well, you could read quite attentively balance sheet and profit and loss account. But then you need to be qualified in that somehow. But when you know just a couple of ratios, just the numbers, and then you know how to interpret them, nowadays they're all calculated down at the bottom of the report, because the people who prepare these reports, they know that not everybody is a qualified accountant, so they present them in a way that is easy to digest. And as well, like you are a manager of a huge investment fund, you will not calculate each one by hand because you would go crazy. You just see where they are, these figures, and then you make a decision in about 30 seconds. So therefore, I'm strongly an advocate and supporter of all kind of ratios. And these ratios, return on investment, like all these profitability measurements, these measures include several different types. Return on asset, on equity, earnings per share. This is something that is very important in circumstances of the stock exchange. Economic value added, so-called EVA. It's as well a complex issue. People agree, people do not agree, but it's interesting. Return on dividends. And then sort of very important is this relation of return. How we understand this return is other situation. But generally, we tend to think that the return is like net profit. And what we do, we just compare this net profit with several other numbers from the financial statements. And if the management knows what they are doing, surely they manage all these kinds of numbers, results in their business in order like to present this final rate of return very favorable. And as I mentioned on the bottom line, it's mentioned that, you know, when somebody's outside investor, he would just look, or she would just look for a couple of numbers, very easy numbers. I assure you that majority of investors on a stock exchange, they look only on 3 numbers, 3 aggregates. And then they make 95% decision on these 3 small numbers. They do not read everything about the company. Right, so we now have the list of all of them, like return on sales, return on assets, return on equity, financial leverage index, oh, plenty of them, plenty. You could add many. But we will concentrate today on a couple of them, and we will tell the exciting story of DuPont formula. What I think is it's like absolutely cornerstone of corporate finance. And I'm very unhappy that the man who invented this did not get the Nobel Prize, because if anybody is supposed to have, he would have it, because this is a wonderful combination, this DuPont formula. Let's start. We start with a very basic one, and this one is return on sales. What is return on sales? As the name indicates to us, this is like we have this return, which is our net profit. Some people call it net income. We just possibly at the accountancy lectures you already touched this, that in some places some things are called differently. Okay, this is what at the end of profit and loss account, net profit. And we divide it by sales. Sales meant like revenues. Everything that company sells, everything. So this is return on sales is just this number, just this, net profit divided by sales. And then we have a number or percentage. These returns generally are shown as a percentage. But if it's a percentage, then you have the sign percentage. If there is no sign, then obviously it's a number. So what we could generally say about return on sales? Generally, we evaluate efficiency of the company, because does it matter that companies sold a lot of things? Maybe they sold like millions of copies, millions of items, and it's worth billions of dollars, yuans, if they make loss. So does it make any sense? Or we find that company, for example, made $10 million net profit. Is it big or is it small? How could we judge? 10 million for me personally, it's a huge amount of money, just gigantic. I would love to have net profit like that. But if the sales are in billions or trillions, then this 10 million is just such a tiny number. So we use return on sales as the first initial judgment on how the company is run. Because what we do, we just relate the profit of the company, net profit, to its general sales. So again, if we want to put some explanation to this ratio, we just could say, imaginatively, how much of profit, like how many dollars, are generated per $1 of sales. Generally, it would be surprising that it's like dollars to dollars, it would be cents to $1, right? So this is the measure. And again, because obviously it's done normally on a yearly basis, we just calculate with the financial statement of the company. So generally it's yearly. So we just judge it what happened, like sales, profit and sales for 2017, then 2018, then 2019. And then we could measure this return on sales year after year. And obviously, when this figure increases, it looks that companies sort of getting more efficient in a sense of squeezing profit out of sales. However, if it's decreasing, it doesn't look good. Means that the company sells a lot, but still profit of that, it's not impressive, it's going down. Like there is plenty of competition perhaps on the market. Or maybe the product that the company sells is old-fashioned, ancient technology, whatever like this. And then the company could not squeeze enough profit out of sales. And if we have this analysis that we could build a trend line of several different periods, and then you could see if it's a steady line. It's generally very good if we have a really large number of observations, like 20 years. And again, the efficiency of generating profit of the sales is this performance that interests us the most. So we do it in consecutive years. And now, this is very important because it's expressed usually in percentage points, like, for example, 9.6%. So it's a number. So it's a wonderful tool to compare between the companies that are different in scale. Of course, when you compare a company of a size of a small corner shop and a giant like British Petroleum, it doesn't make sense at all from the beginning. From the economic point of view, it's a completely different scale. But even if it's like twice as big, on the first glance, it might be a bit difficult to judge the numbers if we have the raw numbers from the financial statement. But when we have this return on sales in percentage, then we have just this. We compare number to number, like that. And we just we ignore the fact that in one case it's 100 million sales and in second is 200 million sales. Because what we finally compare is just this percentage. So it allows us to compare between small and big. But, and this is the catch, yes, this return on sales tend to vary depending the industry. And of course, other circumstances as well, like different countries, different regimes, different technologies, different taxes, different ways of doing many things. But still, of course, when you are an investor, you will not, and you think about investing, say, in shipping company, you are interested in shipping company. You will not compare a shipping company to a vegetable corner of the street shop, or you will not compare it to the airlines, because you are interested purely in shipping. Therefore, these comparisons should be done within similar industries. It's as well important to say that unfortunately, like many other ratios, this as well has some variations, because people would say, no, we cannot compare ROS when there is net profit, because we forget about many things like taxation, interest, and so on and so on. Therefore, some authors, some professors, some analysts, they insist on that in numerator there should not be net profit, but EBIT, this legendary EBIT, earnings before interest and taxes. So it, by a concept, would allow to compare companies operating with different capital structure and in different tax circumstances. And in this, obviously, situation, there is another name like operating profit margin. It's a fair name, but I would just, and in this situation, it will be EBIT divided by sales. So we have to remember, sometimes it's with EBIT, sometimes with net profit, but for our purpose of our thinking here, we will stick to net profit. However, I put it in order for you not to be surprised if you encounter this variation. This is the explanation. In this variation, operating profit margin, yes, it's before the influence of taxes and leverage. Brilliant. It's a bit long. We have just finished our talking about ROS, return on sales, and now we have return on assets. All right, so this is the formula. Return on assets. We have net profit, in other words, net income divided by total assets. It's again very interesting. Because now what we do, we are concentrate not on what company sells, and it was previous ratio. We are now interested in what company possess. Yes, there is many things that company owns, and we are now interested how the things that company owns is sort of converted in the economic process towards profit. Yeah, we still think about profit. This is the most important thing in economics, profit. So we have this description, okay, step by step. A company is perceived as efficient by investors if it can generate an adequate return, means profit, while using the minimum amount of assets to do so. Right? This also keeps investors from having to put more cash equity into the company and allows the company to shift its excess cash to investments in the new projects. It's a bit long in description, but generally what's all about? It is about that the company has some assets. And we as investors, owners, we are interested in that these assets, this something that company owns, is used in the best possible way to make our profit. Because if it's not, we will take this something, this asset, and bring it into another business. Or like we are not happy when the managers would say to us, yeah, these assets are not enough to generate profit, and because we have to put more and more in the company. No, we will not be happy about that. So this return on assets, it's very important. And I put it in red. The return on assets measure or ratio is considered a critical one for determining company overall level of operating efficiency. Because we have all these operational things in economics, in business. Because what we are now talking now is purely business. Yeah, we have operations of our companies. They do something, they operate. So we want to know how good they are at this operation. They have something to start with, and then they need to operate that in order to bring us profit. As simple as that. There are some sort of restrictions and formula descriptions. So the description: divide net profit by total assets. We know this. And there's, again, endless variations of this formula. I just warn you. It could be return on fixed assets or any other assets, return on current assets, or because they are different. Yeah? We know already that the proportion might be different. Some positions, including accounts receivable and inventory, since these areas can be major users of cash. Yeah, we would like to know what is the return on these positions. And again, we could use it with the depreciation or net of depreciation, as well, different combinations. What we do, we just take total assets in our calculations, total assets from the financial statement. As it's written here, the best formula contains assets at the gross value. And again, one remark: as long as the formula composition is used consistently over multiple time periods, thereby ensuring consistent long-term reporting. You know, because we cannot change this ratio from year to year. When we do analyze a company, we just have the same combination, the same pattern, the same content during the years. So please, this is a very important thing. Then again, this return on assets, maybe this caution number one, may be of little use that in the situation when profits are very small, like minimal profits, because it's a percentage basis. So with slight changes of the level of profit, then this percentage suddenly will be higher. So we have to be extremely cautious when analyzing a company that had a very bad moment with very bad results and very tiny profits. And then, like, I don't know, giant company with 10 million profit. And then next year they have 200. Because something has happened exceptionally during this year, we have to remember about that. And again, caution number two, although the value of short-term assets such as accounts receivable is probably quite accurate, this may not be the case for facilities and equipment that were obtained many years ago. In order to obtain a more accurate determination of this measure, one should consider conducting an appraisal of major assets and using this value in place of their historical cost. What happens? That because it's accountancy, so we have the value done by accountants. And even if we use some depreciation, nothing is sure that this depreciation method is a good one. Maybe we value something extraordinarily because it was valued a long time ago, but still it has no value at all. Or we have in the books something that was valued very, very high numbers, but because the circumstances changed and this property, this land, these machines are now obsolete, and we could not do anything with them. So then it really hangs on this return on asset in practice. One thing before we go to the weighted average issue, I will just say it verbally, maybe coming down to this point. Look, why this return on asset is so nice? Because again, we have the same set of properties that we had at the return on sales. It's just a number. It's just a percentage. So we could use it in comparing between companies everywhere in the world. Small, big, these and those. Because it's a number. So for investors, it's a fantastic number to know how companies use their assets. And again, it's the same thing as at the return on sales, that generally we should look on return on assets in the same industries. If we look on, say, mines or steelworks or shipyards, they involve massive amount of assets. And in these industries, they are fairly secure. They do it on a long time. It's once invested, it's for a long time, and so on and so on. But these returns might not be too big, but it's like in the same industry. However, if you are operating on pretty tricky and risky industry, like, for example, tour operators, they have quite a limited amount of assets. So their return on assets should be quite substantial. But obviously there are many risks. So we could compare within industries. Therefore, this is a wonderful tool of comparison. Now, there is a certain issue. It's called weighted average issue. Look, average total assets are usually calculated by adding the beginning and the ending total asset balances together and dividing by 2. Why we do it? Come on, let's wake up. Because we have numbers from the end of the year of activity, right? So it's taken from the balance sheet, normally 31st of December, right? And we just take the profit from the whole year, right? So the profit from the whole year, let's say 2019, is divided by assets at 31st December of 2019. And what has happened in November, a company just sold a gigantic part of assets, the whole thing is distorted completely. Or what would happen if other way around, company just bought in the last month? The whole year they operated on small assets, and all of a sudden they bought quite a substantial, huge asset. And our return on assets will be hugely distorted. Therefore, there's a concept of like taking the number of assets from the previous year balance sheet, adding to this year, say, balance sheet, adding up and dividing by 2. Then we have the average. Of course, it's not ideal, because the more complicated weighted average calculation might be conducted, like really chopping into a month or several periods. But this weighted average issue is very, very important, and we have always a close look on this. But now, look, why in case of return on sales, I have not mentioned that. Why in case of return on sales, there's no such problems with the average of 2 measurements? Who knows? Pure Schwarzjahr. Who knows? Who knows why? It's pretty obvious. Just remember what is where in the financial statement. In case of return on sales, both net profit and sales are taken from the profit and loss account, income statement. So therefore, they're both for the period. There is no need to make an average because they are both for a period. But the number of assets is taken from the balance sheet, so it's for the day, specific day. And therefore is this weighted average concept of assets, because it would like sort of spread these two figures that are for the day for the period. Then it would be more period meaning. So please note that you might calculate this on the number of assets or sort of weighted average assets. And like this remember thing, that both net profit and sales come from the profit and loss account, that is like entire period. And if the numbers are for year 2019, it means that they cover all sales and all net profit generated by the company during this year. Nice. Again, again we have the variation. Oh no, oh yes. We have the variation. So again, this is the variation about numerator. And there are again certain reasons to use EBIT. Like, you know, this major issue is this avoiding the influence of interest and taxes. So, and some practitioners and professors and analysts, they insist it should be EBIT, but then in order to make differentiation, sorry, it's late. We use this expression basic earning power, Brigham and Davis use them, but then it's very unfortunate because BEP means something very precise and very, very different in finance, so it's all confusing. Anyhow, remember that sometimes these return on assets, ROA, may be done EBIT to assets, okay? Sometimes it's spelled, I did not put it on in the lecture, like EROA, and then we know it's with EBIT, okay? Like EBIT return on assets, EROA. But we have to know it. And again, this is to show how this return on assets work without influence of taxes and leverage. I think the next, there's one thing more. There's one thing more. Again, a variation. Again, a variation is that in management accounting, sometimes people insist, this is what I mentioned, that sometimes you could have assets that are sort of idle. You have some lands that do not generate anything, or you have some buildings that are shut down, they do not generate anything, but still they are assets, right? So people sometimes insist on making return on operating assets. So assets used to create revenue, operating assets, only those who really do something. So why is that? This measure varies somewhat from return on assets because we just take these ones that actively use to create revenue. And therefore, it targets the attention of the management to these assets that are really used in producing something. And because obviously there will be a difference between return on assets and return on operating assets. And if it's substantially high, then it will be a pressure like to eliminate these unnecessary assets, sell them, or rent them, or do whatever you do with them. And again, because it's a caution that they could be sort of some deal of interpretation, which ones are which ones. So if we allow for the outgoing elimination of assets, we risk that we will eliminate those who are quite important. So it should be always carefully reviewed. But we have to concentrate on this, because this is the most exciting one. You will see. It's such a small one, but so exciting. Return on equity. So what is the The formula is as simple as it could be. Net profit divided by total equity. Nice. So what we have in this description, the calculation is used by investors to determine the amount of return they're receiving from their capital investment in a company. It's equity, their own money put into the company. So we just compare net profit of the company to own money put dedicated to the company by stockholders, by shareholders. This is a commonly used measure, one of the most popular. Surely, one of the most popular, but sometimes it could be misleading. We will just say briefly about that. But we have this formula, net profit by total equity. The numerator must be net profit. You remember, we had these variations with EBIT in case of return on sales and return on assets. We had the variation, and we said something that we do it in order to avoid complication with issue of taxation and capital structure, debts, and so on. So why? Why on return on equity there's no other questions? It has to be net profit. It cannot be EBIT. Why? Anybody could give me a nice answer why? And this is such a tricky question. So please think. You are investors, yes? You put the money into the company, right? Your hope is to receive dividend, like part of the net profit. So simply you do not care about any EBIT or whatever. If there is a taxation, it should be in favor of the company. If there is structure of interest, it should be in favor of the company. So you don't care. The only thing you care is the net profit, nothing else. Therefore, in return on equity, net profit divided by total equity. Okay, again, there is variation. Normally there are variations of something like a ratio. So there is a slight variation. Because in order to obtain a better picture of the ability of a company to generate a return from operating activities only, the measure can be modified like net income from operations divided by total equity. You might say, what's it all about? Professor Nagórka has just said that net profit is the most important, and now it says something like from operations. Yeah, there is a tricky thing, because when you are an owner of the company does something, produces shoes or ships or steel, or it's a tour operator or runs hotels, something like this. But all of a sudden, say, they made some operations on stock exchange with idle money, and then it brought wonderful profit. Yeah, but it just brought once. You just want to know how good your managers are in running your money in your company to produce net profit yearly, year after another, and to bring you some money in form of a dividend. This is the thing. Because again, return on equity is ideal for comparing the performance of the company year by year. Of course, the composition of the ratio must be the same. We just mentioned that. But then we look on the company year by year. There's one caution about that, because this is related, equities sort of in assets related with debt. When we have a situation that your managers want to improve this ratio, they might do a trick they will incur debt somewhere and then buy back some stock to diminish the number of equity, right? But then they produced a huge debt, and then this debt had to be paid back in future. So at the moment, your company has brilliant return on equity, but then later in next years, something might happen because there's interest to be paid. So look, if there's an increase of return on equity, if there was not this trick done there.